Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes, both fundamental and technical, driving markets at the moment. Whilst I just let you have a quick look at the disclaimer, just want to reiterate actually, or just say that really keen to break down all the market jargon and complexities that we all read about. So if you do have any questions, please do try and ask them along the way in the chat function, hopefully. And I'll try my best to answer those as we go, or at least by the end of the webinar. This week, we'll follow the usual format, actually. So we'll just check out how markets are shaping up at the moment. We'll have some thoughts, of course, on this current banking crisis that we're currently seeing. And we'll check out a few markets that we're watching that you can watch to sort of follow and give us a guide as to what markets are thinking really and where we are and where we might go to, of course. And then we'll look at equities as we normally do in the technicals around the major stock indices around the world. We'll then briefly touch on last week's two key events. US CPI is still important for sure, and also the ECB meeting, definitely important really as a guide to how potentially the Fed will act this week. Then we'll focus more in depth on the FOMC meeting, of course, on Wednesday, as well as then we also get a Bank of England meeting the following day. We get UK CPI data actually on Wednesday. That's UK inflation data as well, first thing, UK time Wednesday. And then hopefully if we've got time after that, we'll just check out gold as well. Went through 2000 actually earlier this morning, just checking out the current price just below that now. So a lot going on, of course, and hopefully we can help you sort of navigate these really volatile markets. Well, certain markets are really volatile. Currencies, actually, we can see from here, this graphic chart that we've sort of added over the last few weeks. On the left-hand side is last week's year-to-date performance of the majors. And then the right-hand side is a few minutes ago, just took a snapshot. And you can see, yeah, sterling surprise sort of strength in sterling. We'll touch upon that when we go through the Bank of England. Generally looked at as a sort of risk sentiment currency or surprising risk currency, risk sentiment currency, if you like. But also then at the moment, of course, it's about the banking sector and potentially UK banking sector sort of relatively looking stronger than, say, Europe, stronger than the US. So some outperformance in sterling, outperformance in the dollar. We'll touch upon that. Actually, it's quite a nice idea around dollar strength, which is called the dollar smile. I'll touch upon that shortly. And then you can see yen is obviously strong, safe haven currency. And then we have the sort of struggling risk cyclical currencies, Aussie, Kiwi, all the commodity dollar currencies still languishing, although slightly pull back those losses against the dollar over the year. Okay, at the moment, markets obviously digesting the historic banking news over the weekend. That is really the bailouts. I know bailouts are not being, or that word is being frowned upon slightly by the authorities, especially, and Twitter is certainly sort of commenting on that word, and authorities not using it insofar as the UBS merger or rescue of Credit Suisse. Risk on sentiments that kind of prevailed actually initially actually at the Asian Open earlier today, but then that turned sharply the other way. There were or have been and still are, of course, concerns about credit markets, and particularly with Credit Suisse's so-called additional tier 1 bonds. I'll go into that shortly, but it's around the potential derating and repricing of bank and corporate credits, and then certainly this contagion risk from obviously Credit Suisse to other banks, to other pricing of these type of bonds, which are held elsewhere across virtually every big bank. Every private wealth manager actually also holds them, especially in the Asia. So it's around this contagion risk that is obviously putting uncertainty into the markets. Of course, that then complicates the major risk event on the calendar, at least for this week, which is obviously the Fed, which meets on Wednesday. I've just got a couple of charts really trying to just highlight how sort of big this mess is, if you like, in the banking sector. This is, don't want to get too heavily into it, but it's a CDS chart. So there's a credit default swaps chart. That's basically the risk of default for Credit Suisse. Thought it's worth putting in there. Obviously now the news overnight has kind of taken over this, but yeah, CDS, basically credit default swap. So it's a financial derivative that kind of allows an investor to swap or at least offset credit risk with that of a different lender or investor. And you can just see obviously this massive spike higher, and compared to other sort of big financial events, obviously the pandemic, we had the Euro crisis 2011, late 2011, and then obviously GFC in 08, 09. So you can just see how sort of stressful it was. This was last week actually, so how big an event that was. Also, I've got here then more recently, this is a snapshot from this morning from the FT actually, but just showing you sort of where European banks are now as well. So the big European lenders, ING, Deutsche, SocGen, and Commerzbank, and you can just see their falls probably, from a couple of weeks ago, so the 6th of March, then obviously a sort of slight pullback on the 13th, so last Monday, before then falling again. All rebased, as you can see, but percentage drops. So big percentage drops in these big lenders following on from obviously events with Credit Suisse. We said last week, and I think it's worth repeating again, the lessons from the GFC, from 08, from that European crisis in 2011, are the kind of the early cracks and the first rescue attempts that you see by regulators are often not enough, as these events kind of do not happen in a vacuum. And we said that last week after the SVB rescue, if you like, Silicon Valley Bank, so the travails in sort of the US banking sector, obviously then hit the European banking sector as well. Credit Suisse on Wednesday. Then you had obviously US lenders as well, big US investment banks putting in 30 billion to try and support the sector, support small regional banks in the US. But we've had obviously a lot of volatility around that every day actually from last week. Currently then, you have First Republic Bank in the US. We've been following this, just the pricing that you can get after hours, even on Google. So that was down some 30%, I think, on Friday, after that big deposit, if you like, of 30 billion by those big US investment banks. But the bank, First Republic's sort of in spotlight, and that dropped sharply even after that big deposit. I think it's down again today, although not by such a big degree. So tension still there, still evident. And obviously then we've had the Credit Suisse news, full-blown takeover, if you like, by or engineered by the SNB, so the Swiss National Bank, and even as well the authorities and the government. We've also had, I should point out, some coordinated central bank action. So that's additional dollar liquidity from big central banks as well as the Fed. And basically that provides extra dollar liquidity to money markets. and it's kind of being seen as a sort of precautionary safety blanket, if you like. A safety blanket, yes, which can provide dollar funds as central banks need them. At the moment, it's important to stress there aren't or haven't been any outsized demand for dollars recently. Obviously, things are changing rapidly, but at the moment, it's kind of more of a safety blanket which hasn't been used. So just to stress that. Just on the sort of UBS deal, on the Credit Suisse falling, there is some talk around, as I said, these additional Tier 1 bonds. Basically, the issue or the contagion which had spread earlier this morning anyway on the open or after the open of the Asia and then on the open of Europe has just been around this sort of blatant, if you like, upending of the hierarchy of debt which companies have. And that's impacted other share prices this morning, as I said, and sort of trumped that rescue news, if you like, of combining two global systematically important banks. As I say, lots of talk around this 80 additional Tier 1 bonds, and these are kind of hybrid bonds which offer higher yields than other debt, but can be converted into equity in the case of a credit event. But in the case of UBS taking over Credit Suisse, they weren't converted to equity, but were written down to zero, and that then is the problem because the rules have kind of been changed, and then, as I said, there's been this sort of complete upending, this complete reversal of how this normal structure of debt should work. That's kind of it in a synopsis. Hopefully that's sort of clearer to you. I'm sure if you read about it, then yes, that's been the issue at the moment and this morning. For us then, key markets to watch at the moment, apart from some of these sort of more obscure credit or bank measures or gauges, certainly the yen, certainly gold, and also then the dollar. And as I touched upon, so those are all kind of haven, as I'm sure you're aware, safe haven assets, which has obviously been bought up by investors over the last week. For the dollar, you kind of got this lingering banking sector stress, and banks then potentially wanting to hoard those dollars, and they would get those potentially from that line, that dollar liquidity line that's been put in place over the weekend. But there's potentially then a small underlying bid to the dollar, and we have seen that over the last week, where obviously the US tensions have either got worse or sort of softened, and you've seen the dollar move on the back of that. As I said, wanted to just bring in this idea of the dollar smile. Don't remember actually who thought of it, but it's always good to remember this sort of smile curve. If you think of a smiley face, if you like, the dollar does well at either end. So when things are very bad or very good. So very bad was at the start of the financial crisis in 2008 and start of the pandemic in March 2020. But then in the middle, if you like, so the dollar generally gently sort of sinks at any conditions in between. So either very good or very bad is where the dollar smile kicks in. The dollar does well. But otherwise, when we're in those other conditions, then it kindly gets offered. Obviously, if we do get more settled financial conditions going forward, which is obviously key for everyone, then that should allow the dollar to reconnect with its now softer interest rate differentials. So where those treasury yields have come back massively from where they were, then those treasury rates have then narrowed with other countries' interest rates, and that's what we mean by that interest rate differential. And then potentially that leaves the dollar more offered again, and there would be more sellers. In the meantime, just one other chart I think worth pointing out as well. Again, just to highlight, really, we don't have to understand exactly what it means, but you can just see the spikes, which are just show you the sort of crisis in the banking sector. So this one is the weekly Fed balance sheet data, if you like. So it shows you a huge size of that spike in the Fed's emergency lending, and really underlines that this is, you know, a serious crisis in the sector, as I say, bigger than the pandemic there, you can see, and sort of getting up towards the 08-09 GFC point in time. So this is, yeah, as I said, where banks are, this is from, last weekend's liquidity support that was put in place by the Fed and the FDIC. That's a regulator in the US, and they offered funds to banks, regional banks especially, to shore them up, shore up support, of course, for the sector. And you can see that was really, people were kind of, markets were looking at this to see how needy banks were effectively, and you can see a massive spike. So a big worry, and really shows how vulnerable potentially the sector still is to obviously falling deposits, and people taking their money effectively out of some of these small regional banks. Again, it's about contagion, it's about sentiment to the banks, and it's about trust. Those are the key words really that we focus on, and look for obviously more pain potentially if there is some in the banking sector, and then obviously some of those haven assets, the yen, gold, going higher or not, of course. If that contagion, those fears dissipate slightly, then obviously havens get sold, and risk assets will be bought. Okay, just as far as some of the technicals go, we've got here obviously the S&P 500, the weekly chart. We did fall through last week. This is the weekly chart. Yeah, you could see we fell through a fib level that we've pinpointed here at 39.84, so 3,984. You can see there the red candle from last week, just falling through that fib level, which is the 38.2 of last year's decline. So quite a big fib level. After touching sort of the halfway point, fell below there, and also then just fell below that long-term trend line sort of resistance support. So didn't manage to stay there, or we're not actually this morning, and we're just sort of bang on it now. So we're trading around trend line resistance supports, but below that fib level still, and below the 50-week moving average at 39.76, which is obviously then below the key psychological level of 4,000. So little sort of move higher potentially, but yeah, still trading around key levels. To the downside, then you've got a sort of minor fib level at 37.90, ahead of then the 200-week moving average, which obviously offers support. You can see here around October in that sell-off, the 200-week moving average is at 37.30. If we go to the daily, yeah, a little bit more messy, of course, around sort of that trend line, and then around the sort of 200-day moving average, 100-day moving average, which is that black and grey line there. So sort of offering support resistance just below 4,000. That's the S&P. For the NASDAQ, really interesting actually. NASDAQ 100 of this is, if you go to the weekly, you can see, I think we pointed out 2 weeks ago, that big bearish engulfing candle. So that looked bearish. It didn't look good. So all the prices from that week engulfed the previous week. But then we had a bullish engulfing candle. You can see here. So all the prices, the range, engulfing the previous week's range. And also then you can see held up by looks like strong support at the 200 week moving average at 11,727 there. So really interesting price action in the Nasdaq, pushed above the 50-week moving average now, and we're sort of looking at potentially year-to-date highs at 12,880. Nasdaq 100. This is, you can see there the big move Thursday, and sort of pull back Friday, but interesting, sort of broken, probably sticking the trend line there as well, broken that, and potentially if we can hold probably around 166, which you could see there, then potentially yeah, that looks sort of more positive. Just then, let's look at the DAX German index, which again, you can see on the weekly, we weren't able to close above February's high at 15,656. I sort of mentioned that a few weeks ago, I think. Then obviously we broke this rising trend line support then, and we've touched now a fib level. You can see there, 61.8 fib level of this move up from the September lows. So that fib level's at 14,581. You can see today's price action, actually we pushed below that, and then strong buying has pushed rebounded, really decent rebound, and above as well the 100-week moving average at 14,642 there. So a bit of support potentially for the DAX after that sharp fall, but obviously we'd have to probably get above that breakout level really to assume more upside. You can see on the daily there, that fall below that dotted line there, which is that fib level I talked about. You've also got the 100-day moving average there, that light grey line at 14,695, so potentially offering initial support, and it has supported prices last week. Just quickly on the FTSE 100, big drops really. FTSE obviously has a lot of banking stocks in it, and you can see, yeah, it was slammed actually down over 5% last week, and it's now below the 2020 highs at well above here at 7,689. And as I say, now we're on the weekly chart here, so we have a sort of near-term fib level we've drawn in there from those September lows, bounced off that 7,219, and then we're back up potentially to the halfway point of this rally. You can see there at 7,377, so that might offer a little bit of resistance. And then we've got the 50-week moving average, light blue line there at 7,425. That's on the FTSE 100. On the daily, you can see that nice rebound. We were sold off, I think, by over 1.5%, looking grim, but you can see the oversold nature in the RSI there actually on the daily. Check out the weekly, we're not oversold at all, actually, interesting. But on the daily, yeah, oversold, sort of strong pullback back to this area of potential support around actually the December, mid-December lows you can see there. So around sort of 7,300 or so, just above that. That's on the FTSE. Okay, now we will go to just a recap of the couple of last week's events, the US CPI data, just a graphic here. You can see a review of the key numbers, really illustrating still persistent underlying inflationary pressures. The headline, yeah, 6%, so actually falling from the 6.4, but obviously 6.4 was actually above the 6.2 the previous month, if you remember. And still elevated, still way above the Fed's target of 2%. A lot of, I've said consistently, core is probably the main number that excludes falling energy prices, also excludes food, which is volatile month to month. You can see that hit 5.5%, so it was in line, but just a touch below, 1/10 below the previous reading of 5.6%. Then you've got the core monthly reading. That is a worry, 0.5%. above last month's and above estimates. And also there, I've put in the sort of Fed's new favorite indicator, that's core services inflation less shelter, and that slipped very modestly, but certainly this 0.5 monthly figure, way above what economists like to see for that number falling to try and hit the target. I think that monthly target needs to be about 0.17%. We're way above that on the monthly reading over the course of numerous months, then to bring us back down to the 2% annual target. So worries there, still hot inflation. And similarly, actually, other measures, there's the Atlanta Fed's CPI. I think I've talked about that previously, but that's still sticky, actually picked up to 6.8% on an annualized month-on-month basis. And that's clearly too fast for the Fed. And well, yeah, energy and core goods CPI, they came out below expectations, but as the labor market remains tight, then services remain the key focus for monetary policy going forward. Of course, a lot may be impacted by obviously the last few weeks events, but at the moment, prices still very, very sticky and very elevated. That's US CPI. I'll look at the dollar, the DXY index shortly, but just moving on to the, where are we? One sec. Yeah, sorry, the ECB. I haven't done a review actually of the graphic, but just briefly, they hiked obviously rates by 50 basis points. If I just pull up Eurochart at least. But yeah, ECB hiked by 50 basis points, gave no indications really for the coming rate path, in line with what we thought, what most ECB watchers thought. The ECB communication clearly highlighted the risks prevailing to the economic and inflation outlooks, but kind of said that should the baseline prevail, once the current turmoil subsides, then more rate hikes may be needed. They kind of sort of showed off, if you like, this, or were trying to show off a sort of dual track monetary policy approach, is what some, I think one investment bank called it. So they've given up on forward guidance, of course, because uncertainty is very high. So they essentially, they don't want to be made to look stupid, if you like, in some senses, because their forecast would be redundant very quickly with obviously all this, all the tensions going on at the moment. But the communication, especially by Lagarde, sort of clearly showed this preference for a focus on inflation over financial stability. So you kind of had those two, that dual track monetary policy approach, as I've said, between financial stability and then focus on monetary policy and inflation. And I think the first sentence in the ECB statement was actually inflation is projected to remain too high for too long. So definitely importance there of putting it as the first sentence over and above, say, uncertainty concerns. And as I say, yeah, this trade-off between financial stability on the one hand, price stability, monetary policy on the other. Of course, it's a fine balance, and Lagarde actually acknowledged that, saying clearly the ECB has the necessary measures, if you like, to fend off any serious concerns in financial stability. And of course, they stepped up actually over the weekend with the other central banks offering dollar liquidity, if you like. But I think especially the message was clear as well, that they're very keen on further hikes and fighting inflation. Just checking out, actually, before we look at euro dollar, obvious to say, of course, much depends on Credit Suisse woes, UBS woes. UBS stock was down 14% on the open, but has rebounded slightly. So that's probably another stock price if you want to follow, because of the implications obviously around the wider sort of financial system in Europe, and then the contagion issues spreading from those. I think really interesting for the Fed then, this split between this dual mandate, if you like, or at least a split between price stability on the one hand, financial stability on the other, and then also the ECB certainly having the confidence to raise rates by 50 basis points, even during this volatility. Just on the one final thing on the ECB, actually, they did come out with their staff projections. Those are every 3 months, so really important, but they obviously haven't incorporated the effects of current developments, but inflation was forecast to come back to target in late 2025, even with growth above trend in both 2024 and 2025. So interesting sort of potential forecasts there for the ECB. Markets now, they only see probably just around one more hike of 25 basis points at their next meeting, and then policy rates to remain on hold until next year at least, before potentially a sort of return to neutral level by mid-2025. So obviously that's changing all the time, that pricing. So big caveat there, but that's kind of last time I looked, or especially the start of this morning. For euro dollar then, certainly still caution around the health of the European banking sector, and the pair will definitely be volatile, of course, into the Fed and the FOMC decision on Wednesday. We do get preliminary PMI readings for March on Friday for the Eurozone. Always important data, leading indicator, or a survey at least, which potentially have recently anyway painted quite an encouraging picture for Eurozone growth prospects, and kind of at the moment anyway, consensus expects those to endorse that recent decision by the ECB to really keep tightening policy despite, of course, the turmoil. For euro dollar then, you can see, if we just go to 1 hour chart, I'll just show you obviously this dip, sort of first thing this morning, and the sell-off after the Asian close really, and the European Open, but then since then we've it's been quite positive really, and that's really instructive, as definitely as US stock markets open, and obviously US traders come back or come to their desks after digesting, of course, all this news overnight. You can see then we're kind of trapped, we think, between this 100-day moving average and the 50-day. That's acted as resistance, the 50-day at 107.26 or so. So be interesting whether we can get above there. And then last week's high at 107.59 potentially. Then we probably looked at a near-term target, the mid-Feb high at 108 potentially, if we can get above there. Otherwise, if we roll back into this sort of noise, back and forth, if you like, then we've got support 106.10. That's a long-term support we have, which is from it's actually a fib level, sorry. So 38.2 fib level of, you can see the decline in 2022. So that's at 106.10. And then below that, of course, we've got the 100-day moving average of 105.75, and then we've got the lows around sort of 105.37 or so. So those are some levels we're looking at in euro dollar. Okay, let's go to the Fed next. So just obviously the main event. You can see we've got a graphic here. I was going to show you the CME Fed Watch, but in fact, let's just go to that briefly. If you can bear with me 1 sec. So I've used this a lot, and hopefully you might be using it too. So the CME Fed Watch tool, so it's just showing us Fed funds futures, what they expect at the next Fed meetings. Of course, the next one on Wednesday, and you can see, so there's a 62.7% chance of a 25 basis point rate hike on Wednesday, and 37% chance, so sort of 60-40, 40% chance that they don't do anything. They sit on their hands and don't do anything. Just to sort of compare where we were, of course, you can see, last month there was an 82% chance really of a 25 basis point hike, but an 18% chance of a 50 basis point hike. And obviously that was much higher actually before last month as well. So that's sort of near term, if you like. As for the meeting, I've got 55-45 anyway, so that's changed, of course, as we've had slight or better positivity really as US traders have come in, US markets have opened. So that's kind of encouraging for risk sentiment. Really, it's just, I've got some numbers here around what the Fed is looking at. We've got obviously still hot inflation. We've still got a hot jobs market, if you like, really punchy non-farm payrolls, headline figures, even though, of course, we have had a slight uptick in the jobless rate, in the unemployment rate, but then we had that softening wage growth earnings data, if you like, at the monthly non-farm payroll report. I've put in here really, we've got we will get the latest Fed projection, so that's a dot plot for the FOMC officials. Will be really interesting. Haven't had it since December, of course, and if you remember, the peak terminal rate went up to 5.1% in December, and potentially I think a lot of sort of economists looking at that moving higher, which will be really instructive, of course, potentially for risk markets, because it's basically saying that the Fed expect rates to move higher from where they are currently, and that kind of implies similarly to the ECB that they don't see systemic risks in the banking sector. They don't see contagion spreading, and that is, of course, positive. It does mean, of course, that rates will go higher, and potentially from 5.1% peak terminal to around 5.4%, I think. Not sure of the average of economists, but potentially around that would be really instructive. Along with, of course, those forecasts, we do get, or we have had, and I think it's really important to point out, we've had a tightening of financial conditions. So this means there will be far greater caution by banks, of course, regarding who they lend to, how much they lend to, and at what rates. And effectively, that is a kind of de facto tightening of monetary and financial conditions, as I've said, and that will weigh on activity, really have a lasting effect on contracting the economy potentially, and it kind of does the Fed's job for it. So those hikes, as we've seen, the potential, the sort of pullback in Fed rate hike expectations. Of course, if you remember, we were going to sort of 5.5%, 6%, I think was mentioned by some as a peak rate for the Fed funds rate, but now obviously that's reined in massively with sort of treasury yields plunging and bond prices obviously going higher with this risk aversion and haven buying, if you like. Also important, I think, as well, if you think back or you just think around why this issue is kicked off, of course, it's been the most aggressive Fed hiking cycle in 40 years or so, and also there are always long and variable lags between monetary policy and then its effects in the economy. So you kind of have to think, or we think, that then the potential for a hard landing, the chances of that have been raised, and then potentially going forward, so further out towards the end of this year, we potentially get rate cuts, and the markets have priced in those from pricing them out completely only a few weeks ago. Also, I guess we should remember, of course, the Fed, although it's immaterial now, that if you remember only a couple of weeks ago, obviously, Fed Chair Powell was talking about a 50 basis point rate hike and wasn't averse to that, but obviously would be kind of data dependent, and obviously events have somewhat put that on its head now. Okay, let's look at the DXY quickly. Kind of mapping, kind of following US Treasury yields, which have been all over the place. If I just show you actually the 2-year yield, we don't look at it too often, but this maps Fed funds is highly correlated to that, and you could just see over the last week then the collapse in that 2-year yield, but you can see this volatility, especially from day to day, where we've sort of had more positivity and then less positivity, if you like, but we're sort of hanging around that 200-day moving average, which is around 4% for the 2-year US Treasury, and you can see there where we've pulled back from those lows, which were at 3.63% actually. So back towards, or nearer towards anyway, we're 3.83% now on the 2-year Treasury. Just how that impacts the dollar, we can see sort of just volatility around the last few days. And where are we now? So we're at, we're sort of oscillating between, we're sort of slightly rolling over potentially. So if we don't hold this 50-day moving average, the light blue line, 103.44, and this support from sort of start of last week, then potentially, we could push down. We've got 102.99, that's the pandemic spike high, which sort of held prices, you can see in February. So that could act as support. Otherwise the push higher then possibly capped by the 100-day moving average at 104.73. You can see that light grey line there. Okay, just moving on quickly to the UK. We've got CPI data. I mentioned that's still expected to print quite strongly, sustain price pressures. I think the print is meant to come in at 9.9%. Otherwise, I've just got a cable chart here. Bank of England decision on Thursday. Where are we with that? A 25 basis point hike is on the cards, potentially still, provided, of course, no fallout from everything going on at the moment. Resilience of the UK economy has surprised a lot of people. Of course, GDP slightly better, didn't turn into a recession anyway. Previously, the last couple of quarters, still got a tight labour market. But that said, Bank of England quite or much closer to a pause than probably other major central banks. And obviously it's an opportunity potentially for it to pause in light of obviously the financial stability concerns. If it does, then whether the MPC would resume hiking thereafter kind of remains to be seen. I guess one thing is for sure, and that's sort of the more fractious committee, the MPC going forward. You're likely to have the Hawks still talking about fighting inflation, while you've got the Doves, which are already thinking that rates are too high. So potentially you get a big split, if you like, in the voting, because then we've got the moderates on the MPC. They've sort of they have some cover to pause this tightening cycle. We've had comments from the likes of the chief economist Pill, who already note that there is a lot of tightening in the pipeline. And then Governor Bailey, he's cautioned against suggesting either that the Bank of England is done with hiking rates or that it will inevitably need to do more. Difficult decision for the MPC, just like the Fed, of course, but does give them an opportunity potentially to pause, which they were close to hinting at the February meeting. Markets sort of edging towards, I think, a 25 basis point move slightly. And again, if we think of the ECB, obviously they stuck to their guns with hiking for 50, obviously aware of the risk to the financial sector, but then also probably concerned around their credibility concerns and sort of inflation fighting credibility there. For sterling, then we can see, I mentioned as well at the top of the webinar, just about how it's held up relatively well. Banking sector, of course, not as vulnerable potentially as the Eurozone. And then GBP generally seen as more risk sensitive to risk sentiment, at least more than the Euro. So interestingly, yes, sort of acted or has been quite bullish last couple of days. You can see there we broke last week's high as well at 122.03, so that potentially could offer very near-term support. We're at 122.30 now. Next target probably 122.69, so that mid-Feb high. Before then, you'd probably get up to sort of 123 and above potentially. So it looks relatively quite constructive, but of course, major risk events on the horizon, of course, with the Fed, then UK CPI, then the Fed, then Bank of England on Thursday. Finally, quickly, let's look at gold because there's a lot going on there. We've had 3 really big positive weeks. If we just go to the weekly chart, up 2.45% here, then up another 0.63% before that massive move last week of 6.5%. Traded above 2,000 that you can see there. That's the dotted blue line, black line there. So that's 2,000. We traded up to 2009 actually earlier this morning. 2,000 certainly key level. If we just go back, you can see these spikes higher, but not being able to sustain that 2,000 level. So really important in gold. 2,075 was the August 2020 high, and then the March 2022 high at 2,070. Even then, we pushed up in April, just couldn't quite reach 2,000. Then big sell-off. So interesting whether we can keep up above here. Again, much depends on the Fed, depends on the dollar, depends on these treasury yields, whether they stay where they are, whether we do get some easing in the tensions and treasury yields push slightly higher. They are the key drivers for gold. Interestingly, actually, other drivers apart from those key ones for us, obviously haven buying and whether that slightly gets reined in, but then also heading into this crisis, sort of ownership of precious metals by traders, investors. They had been heavy sellers during the February correction. And also then ETF holdings in gold, they actually jumped the most in a year last week, but they still remain somewhat below actually the 2022 peak. And then speculators in futures, they actually cut their net long position, by a massive 78% actually during the 5-week period to March 7th. So a lot of room potentially there for a sort of reappraisal actually of positions. As I say, all depends really on the Fed, banking sector response, obviously, and where we go potentially, or whether we can keep up above or in these sort of quite lofty levels around the 2,000 mark. If we don't, then we've got sort of near-term support, if you like, at the February high at 1959. That's near-term support anyway. Below there, then we get back to sort of 1920 or so. Okay, that is all we're going to cover today. Hope that's been useful. Haven't seen any questions, so hope you managed to understand everything. Covered a lot of ground, of course, a lot going on. So definitely stay safe out there. Watch the size of your positions. Keep stops in place, we would really advise. And yes, watch out for just really choppy, whippy price action with these major risk events on the horizon as well. Okay, take care, and we'll speak to you next week.